We are going to finish up the process in this particular video. And so what we are going to look at as far as finishing this process is concerned is looking at first this post-closing trial balance. Now the post-closing trial balance is going to be very similar to what we saw on the adjusted trial balance, in that everything that is above this line is going to stay the same. So all of this information will look identical on the post-closing trial balance. The capital account will change, and everything below this line will not be there because they all have zero balances. So in looking at completing this, what we are going to look at is our general ledger. So we will go off our general ledger just like we have with all of our other ones, and so we will have the name of the account. Remember, there is a debit column and there is a credit column. So for our cash account, what we have is $16,730, and that should have a $ with it because it's the first one. The next one that we see is the accounts receivable, 45. Then we have the supplies account with a balance of 200. We have prepaid rent with 1,500. We then would have equipment for 1,500. So all we're doing is just taking this information and copying it. The next one gives us our first credit account, and that is accumulated depreciation, and is a $50 credit. So we would come in and put accumulated depreciation. Is this going to get a $? Because it's the first one in that particular column. We then have accounts payable for 125. We will have a note payable for 1,300. We are going to have unearned fees. And that's going to be for 500. And the only other one that we have is going to be this capital at 18,000. So we would have the capital, and it is going to be at 18,000. And now it's time to figure out if we are in balance or not, or if we've made any mistakes. So in doing this, let me find my calculator real quick. All right, so in this, we are going to take the 16,730. We will add the 45. We will add the 200. We will add 1,500, and then add the other 1,500. And this is going to give us a total of $19,975. Now let's add the other side and see if we're in balance. So we have 50 plus 125 plus 1,300 plus 500 plus 18,000. And that also gives us 19,975. These do need dollar signs in front of them because we are totaling those out. It finishes up the statement, so we need a double underline. And then these are the totals. So we are in balance, and this does give us our post-closing trial balance. Notice my header. It is sewn for you, company name. Post-closing trial balance is the statement name, and it is for this particular date and time that we are looking at these numbers. And then we list all of those out. So if we wanted to go back and compare it with our adjusted trial balance, what you are going to see if we look at this, notice cash is at 16,730, 45, 200. You know, and if we kind of lay them out kind of beside each other, what you can see is that in fact the 1730, the 45, the 200, the 15, the 15, the 50, the 125, the 13, the 5, and then I said this amount would change, and in fact it did. And so that's really all that we have to do when we are looking at this post-closing trial balance. Now, these amounts that you see on your post-closing trial balance will also be the amounts that you will see on your balance sheet. So when you look at your balance sheet, these are going to be the same numbers that you are looking at. And this is done when we get through posting all those closing entries. We get this post-closing trial balance. So the first statement I want to look at is going to be the income statement. Again, notice I do have company name in the header, statement name, and this is for the period ended type of a statement because we're not just looking at one day. We are actually looking at a period, and in our case it is a month, but it could be a month, it could be a quarter, it could be a year. Those are all very, very viable. It could be for the 2 months ended, could be lots of different things when we look at periods, but we would put the ending date, but it needs to tell us what period we are actually looking at. This particular information we can get off of that adjusted trial balance. It also follows that R and E on the closing entries. So you can kind of get some of your balances and stuff off of that as well. So what we will start with in looking at this information, what we see here is we see that fees earned. And so that's really where we're going to start. So we're going to start with the revenues. And so when we look at this particular statement, what you're going to see is you will start with any of those revenues. In this case, I only have one, and that is fees earned. If I had more than one, then these would be listed out here. I would come over to this side, and I'm going to make a column. Now this is just a column. This has nothing to do with debits and credits. These are just columns when we get to the statements. And then like I said, if I had more, I'd have to add all those up, and I would get a total revenue. I'm going to underline this because it signifies that I have totaled something, and I will put my new balance in. Again, if I had more than one, then that's what would be showing there. The other thing that you see if I come right under this revenue is I'm going to be listing my expenses. So when I go through this and I list out these expenses, notice some of the expenses that I have. And the other thing is right underneath this, I'm just going to come right down and keep everything nice, neat, and orderly. So I would have my rent expense. I'm going to create a new column for this because I need to add items together to add or subtract from the other number. So when I create a new column, I do have to have a dollar sign, so I put that $750 with a dollar sign. I'm going to have my supplies expense for $300. I'm going to have my depreciation expense for $50, and I'm going to have my utility expense for $125. Now, when you do your project, if you would, and that's really all I need off of there right now, off of that statement. When you look at doing your statements, make sure that you do these very neatly. If you want to use an Excel spreadsheet or something like that to do them on, you are more than welcome to do an Excel spreadsheet. If you do it by hand, just make sure you go in and it's very neatly laid out and you have your columns in the correct format and all of that. Then I get my total expense, and my total expense I get by adding these guys up, and that was $12.25, and I've just pretty much got that number off of where we did our closing entries. Now notice what I've done is I have totaled all this up and I moved it into the other column because I want to take my revenues and subtract out my expenses from that. And so it's very messy if I have all this stuff together. So that's why I create a new column so I can add things up and move it over. And then what that's going to give me is my net income, or it could be a net loss. In this particular case, my expenses are more than my revenues, and so I actually do have a net loss here of $1,000. And so I would come in, I would take the 225 minus the 1225, and I get that negative number. Negatives can be designated in parentheses when we are doing and dealing with accounting. Again, I have a dollar sign double underlined to let me know that I have completed this particular statement that I have right here. This number that you see, that $1,000 number, this number is going to move to the statement of owner's equity. Which is why the income statement has to be completed first, because we're going to take this and we will move that over. The other thing I want you to notice is that this number is the same number that we saw for income summary. And so this will match that income summary number when you have that. So we know we have a net loss of $1,000. So the next thing we're going to look at is going to be the statement of owner's equity. Again, we have the title of the company, we have the statement name, and we have the date. Again, this is for the period because we are starting with a beginning equity balance, and then we are looking at different items that are coming in. And so when we look at this, we will have our beginning capital amount. And this beginning capital amount, we just started the business in January, so it actually is going to be a zero balance because this is our first year in business. And so I would come out and put that zero there. If I had been in operation previous years, I would go back and see what the ending capital balance was from the previous year, and that is what would go in this particular spot. The next things that I have to look at is I need to add some items. And so some of the items that I would add would be a capital contribution. I also could add net income in, and again that would come from that income statement. The contributions, what you would have to look at is if you go back to your ledger. And if you go back to that ledger and you find your capital account on your ledger, and we look at what has happened for this year, what we see here is that we contributed $20,000, or the owner contributed $20,000 to the capital So that's a capital contribution of 20,000 would come in here. We are doing a new column, so that would require a dollar sign. For this one, we did not have net income, so I'm just going to put a 0 there. For your project, you probably will have net income, so an amount would go there. I then take and add these together, and I'm just going to put the total over to the side, and then I'm going to take and add my beginning balance to these additions, and I come up with a total of 20,000. The next step is to subtract out certain items. And the items that I would subtract out would be the drawing. So this is the owner taking money out of the company. So owner putting money in as an addition, owner taking money out would be a subtraction. Net income is an addition, net loss would be a subtraction. Now you're never going to have net income and net loss. You'll have one or the other. Again, I'm beginning a new column here, so I would have a dollar sign listed out. The drawing account was $1,000. Again, I can get that off of my closing entries. I can get that off, or I can get that off of my general ledger. But I do know that it was 1,000, so I put that in. I did have a net loss, and that net loss is coming from that income statement. So we had the 1,000 that was a net loss, and so I need to put this in here, and then I would add these amounts up and move that total over, and so it's 2,000. And so now I have 20,000 minus 2,000, which leaves me with 18,000. This is my ending capital balance. It would have a dollar sign. It would be double underlined because I have now finished this particular statement. Again, statements, no debits, no credits. All you're looking at are columns to kind of get us where we need to be. And this is what your statement of owner's equity should look like. Again, this ending number is going somewhere. And where is it going? Well, it is going to the balance sheet as my capital balance. And so that's the next statement. So again, this is why we do these statements in order. Our net income is going to move forward to our statement of owner's equity. Our statement of owner's equity balance would move forward to our balance sheet. And so the last thing we have is our balance sheet. Again, the balance sheet is, if you look at your post-closing trial balance, that is going to give it to you. If you look at your adjusted trial balance, the top part of that is where you're going to get this information from. So there's a couple of different places. The balance sheet can be done before or after the post-closing trial balance. And so that's why I said you can get it from there, but you can also get it from your adjusted trial balance. Just remember that if you are using that adjusted trial balance, that capital amount is not going to be the 20,000. It's going to be that 18,000 that we got from the statement of owner's equity. But all of these other amounts would in fact go. I do want to look at this as more of a classified balance sheet. So we do have to separate these items out. Cash down through prepaid rent are things that we consider to be current assets. Equipment and depreciation are going to be fixed assets. And then we have the other items such as accounts payable, note payable, and unearned fees. Note payable can be either a current liability, or it could be a long-term liability. Accounts payable is a current liability. Fees earned, current liabiliity. Again, note payable, it depends on the time. If it's under 1 year, then it's going to be a current liability. If it's over a year in payment, then it would be a long-term liability. So it's really just going to kind of depend. I'm going to treat it as a long-term liability just so that we can do the classified balance sheet and you can see how that actually is going to work for us. So in looking at these particular items, what I see here is I start with my assets. And when I look at assets, the first type of assets I'm going to get to are my current assets. And if I look at that post-closing trial balance, again, or one of the trial balances, I'm going to pick up those first few items. So I'm going to pick up the cash. I'm going to pick up the accounts receivable. I'm picking up supplies and prepaid rent. Now this can be done several different ways in that I can start a column here and then add it, or since this is the very first part of it, I can just move over and I can do the column over to this side because there's nothing that I'm adding it to. So in this case, I start with the 16,730. I'm going to have 45. I'm going to have 200. And I'm going to have 1,500. I will then take these items and add them together and get my total current assets. So when I add these particular numbers together, let's see, I'm at 16,730 plus 45 plus 200 plus 1,500. It's going to give me 18,475, and that's my total for current assets. The next thing that I look at is going to be my fixed assets, and so I'm going to come down. Other items that you could have as categories, you could have an investment category. You could also have an intangible category. We don't have those for this. This is also our plant, property, and equipment, our plant assets, or other names that this can be called when we look at fixed assets. When we look at fixed assets, what we have here is we have the equipment account and we have the accumulated depreciation. Remember, the accumulated depreciation is a contra asset account, which means it goes with an asset. In this case, the accumulated depreciation goes with the equipment account. And so both of these items are what we would see, and we would have to come up with a net amount here. And so what I would do is I'm going to come in and I put equipment, and then I would have less, signifying that we need to subtract accumulated depreciation. Since this is information that's going to have to be added in the future, I do need to create another column so that it is nice and neat. And so I have 1,500 here under equipment. It was a $50 for accumulated depreciation, and then I'm going to move, well, actually I won't. Sorry. And then I'll have my total fixed assets. And that's going to be moved over here, and so I would be at 1,450. So then I would add these two numbers together, and I would come up with 19,925. This does get a double underline because I'm finished with this part of the statement, and these are my total assets. So this statement is actually broken up into two parts. We do have our asset section, and then we'll have our liabilities and our owner's equity section. One of the things I don't know that I've totally mentioned on this, in this particular header, notice it's January 31st because this is just for what the balance is on this day. It's not a period statement, it is a snapshot. It's one moment in time. My balance sheet would change every day. And would look different every day because of different transactions. So that's one of the things that you would look at, is this is not a for the period, it's just a date in time, just like my trial balances are. So now that I've got my asset part done, I can move over to my liabilities and section. And so my next section that I'll be looking at, I'm going to look at my liabilities. And the first liabilities I'm going to look at are my current liabilities. And in looking at my current liabilities, here I have accounts payable and unearned fees. So I'm going to list those out. So I have accounts payable and I have unearned fees. And those amounts, again, I can come over to the side because I'm starting a new part of the statement. And accounts payable was at $125 and fees earned was at $500. So I have $125, I have $500, and this is going to give me my total current liabilities, and that is going to be at $625. I then would look at my long-term liabilities, and I'm looking at my long-term liabilities. The amount that I'd have here would be that note payable. I could have more than one, so I'm actually going to make a column for that and put that $1,300 here, underline it, and then get the total long-term liabilities, and that would be at that $1,300, and I'll put a line underneath that as well, so that I can put all of this information that I need in. All right, so now that I have this in, I would have a total liability section, and I would take and add these two together, and that's going to give me $1,925. The next section is the capital section, or the owner's equity section. And in the owner's equity section, what I have is capital. And that capital amount, remember, we get that from our ending capital balance here. Sorry. My ending capital balance here is $18,000, and that is off of that statement of owner's equity. It also can be received or gotten from the post-closing trial balance, but I am at $18,000. What this puts me at this point is $19,925. This is going to be my total liabilities and owner's equity. Is going to be what I'm looking at this $19,225. The key here is that these totals should equal. So my total for my my total for my liabilities and owner's equity should equal my total assets, because remember, assets should equal liabilities and owner's equity. So these two should balance out and give you those different amounts. One thing also to notice is when I come through, notice I'm kind of indenting in as I go with all of these things to kind of keep it all in line. If I have something that needs to be added back in, then I do create a new column, which is what you will see, throughout all of those statements. So again, assets are going to include things like current assets and fixed assets, could have intangibles. You also could have an investment section, and anything besides the first one. So if I had investments, they would be, have a column themselves. If I had intangibles, it would have a column itself, and then everything would come over and be added together. There are items, and sometimes you might have more than even two columns. You might have 3 or 4 columns. This one I just have the 2 in it. And then same thing goes for down at the bottom. We just have all of those different amounts. We can have liabilities, current liabilities and long-term liabilities are the only types that you can have. And then for your owner's equity, we just have capital when we deal with a sole proprietorship. If we were dealing with a corporation, we would have a lot more here because we would have to have our shareholder information, the common stock, paid-in capital. We would also have retained earnings that would be listed out. So those are some of the things to look at, and this should really help you in finishing out this project.